Welcome to the next section. This section is going to be on annuities. And what we're going to do before we get into this section in the text material is I'm going to kind of do a broad overview of annuities and how annuities work. And then when I'm finished with that overview and explaining the different types of annuities and the functions of annuities, then we'll go back into the book and I will point out for you in the book the various areas where this information can be found in the book. Okay, so we'll kind of do an overview on the board, some explanation of what annuities are and how they work, and then we'll go back in the book and we'll take a look. I'll have you highlight various things that probably will be on the exam, and we'll kind of go from there. Okay, so we'll go ahead and get started. Annuities. So we have annuities, and welcome to this presentation here. And basically we create this presentation specifically for annuities here because annuities is one of the most difficult concepts on the exam, and most exams have a high concentration of annuity questions. Specifically, most recently, a lot of the exams have been reorganized and include a lot more questions on annuities because a lot of people getting this license are getting it specifically to sell annuities. So that's primarily the reason why we have a bigger focus on annuities. And a lot of people, a lot of students of this course, have a hard time with annuities because they're so different from life insurance. And you've been focusing on life insurance this, life insurance that, all the way up until this point, and then you get into annuities. Especially in the classroom presentation, you know, we're all really zoned in on what life insurance is and how it works, and then we hit this concept of annuities, and a lot of people kind of get lost in this area. So this is a very important presentation here, and what we're going to kind of do is overview what an annuity is and how it works, and the way that they might ask questions about these products on the exam. Okay, so first off we'll mention annuities are not life insurance. Okay, well, that being said, why are they here? Well, annuities were created by life insurance companies. Now, you learned earlier when you studied settlement options that an annuity is a settlement option. A beneficiary can choose to take the lump sum from a death benefit from the life insurance and purchase an annuity from the insurance company. It's a settlement option. That's where annuities came from. So they were created by life insurance, therefore they kind of are lumped in together with life insurance. And keep in mind, the reason the insurance companies created annuities was because they wanted to keep that money. Instead of paying it out, they wanted to hold on to it. So that was really great for them from their perspective. So they created this annuity product, hold on to the money, and then pay that money out to the beneficiary over the beneficiary's lifespan. So that's where annuities came from. So I said annuities are not life insurance. In fact, they're the exact opposite of life insurance. Now remember, life insurance by definition is the creation of an immediate liquid estate upon the insured's death. Well, the definition of an annuity is a systematic payout or liquidation of a lump sum or estate over a period of the person's lifespan. So annuities are the exact opposite of life insurance. There is no life insurance protection within an annuity. So you know, we mentioned, well, life insurance, the insurance company wants you to live as long as you can, right? Because they don't want to pay out that death benefit. Well, they're going to be sending you out letters, you know, quit smoking, stop drinking, work out, we want you to live as long as possible. Well, annuities, as we'll see in some situations, it's the exact opposite. The annuity will pay out for your lifespan. So the insurance company, instead of wanting you to live, in some situations, it might be in their best interest for you to die sooner. So they start sending you out cases of vodka, unfiltered cigarettes, you know, Krispy Kreme gift certificates, okay? Well, it's the exact opposite of life insurance. The annuity is the exact opposite of life insurance. Life insurance pays when you die. In some situations, the annuity will pay as long as you live. So really, there's a lot of different uses of annuities. You hear about these different uses, such as retirement purposes. Well, that's the one we're going to use when we do our example of an annuity up here on the board. Because when you retire, you have a lump sum, and you're going to need to use that money to pay for your expenses in your retirement. Well, there's one thing a retired individual will never be able to figure for sure, and that's how long they're going to live. Okay, they might be able to calculate their best guess of what their expenses will be per month for a certain period of time, but they don't know how long they're going to live. They could live 50 years, they could live 60 years, they could live 5 years. Well, if you want some protection against outliving your savings, then you could buy an annuity and take a lifetime payout. Okay, so we'll go into that. Other uses of annuities, lottery payouts. Okay, you see they're using an annuity for that. Sports contract, structured settlements, there's a number of different uses. Just as investment purposes, a lot of banks these days are using annuities as an option in addition to bank CDs. And so we'll learn about why that would be advantageous to the person investing the money. The biggest advantage would be tax-deferred growth in the account, where on a bank CD, if you buy that, you're going to have to pay tax on any interest you earn. Well, in an annuity, interest that's earned, you don't have to pay tax on until it's withdrawn. So that's a big advantage there. Okay, so we'll go on the board and kind of do our example here. The first thing I'll mention is you buy an annuity, they call you an annuitant. Now I want you to remember though, just like in life insurance, you can buy an annuity on yourself, so you would be the annuitant and also the owner of the annuity, but you could also buy life insurance on someone else. You could buy an annuity on someone else as well. So if I wanted to buy an annuity on my spouse, me being the owner, my spouse being the annuitant, I could do that as well. Just keep that in mind as if you see questions on the exam related to that. Remember, the annuitant and the owner are not always the same person. The owner has all the rights. Okay? The annuitant is the one the annuity is written on. Now remember, no underwriting here, because it's not life insurance. So if I want to buy a $10,000 annuity, you want to buy a $10,000 annuity, I'm really old and in poor health, you're young and in great health, doesn't matter. What do you pay? What's the premium? $10,000. There's no underwriting. Okay? So for the annuity member, not life insurance, so no underwriting there. Okay, now we'll use this beaker here to represent our annuity, and this is going to represent our annuity account. Now, the example I'm going to use to kind of explain the annuity is I'm going to say that we have a young person who is age 30, and this 30-year-old wants to plan ahead for retirement and purchase a deferred annuity. So they want to invest over a period of time a certain dollar amount of money, and they're going to use this money in the annuity to supplement their retirement income. Hey, they're figuring, well, you know, hopefully I can retire by the time I'm 65, and I'm kind of worried there might not even be any Social Security at all. And yeah, I have, you know, a retirement plan, but I'm going to use this, my annuity here, to supplement my retirement income when I hit my goal retirement age. Okay, so this 30-year-old comes in to see you, you're a licensed insurance agent, and you set them up with an annuity. Remember, the annuities are sold by insurance companies. So true, you know, you could go to a bank and get an annuity, but it's actually issued by an insurance company, not the bank. Okay, so this 30-year-old goes to see you, say you're the licensed agent, and says, hey, you know, I want to set some money aside and plan ahead for some extra money when I get to my retirement age. And you say, well, sir, you know, how much money would you like to have in your annuity account by the time you hope to retire? And this person says, well, my goal is to have $100,000 in this account by the time I reach age 65. Okay, that's their goal. So based on that, you can tell this person that they have to invest a certain dollar amount per month into the account. So they start doing that. Now, this part of the annuity is called stage 1. It's called the accumulation or pay-in period. So the accumulation stage or the pay-in period, this is when we're paying money into our annuity. And in my example here, obviously, this is a deferred annuity. Now, there's actually 2 stages. Every annuity that is sold has 2 stages. There's stage 1, which we're talking about here, called the pay-in or accumulation stage, and that's when the person's paying money into the annuity. All annuities also have a stage 2. So we'll list that over here. And stage 2 is referred to as the payout period, or also known as annuitization. Okay, payout period or annuitization. Now, when we're paying our money into our annuity, we're always going to be in stage 1. And in fact, to go into stage 2, this is a contractual obligation. If I'm the owner of the annuity, if I'm this 30-year-old, I would have to contact the insurance company and say, hey, I want to go into stage 2. And what stage 2 is telling the insurance company, I want you to pay the money I have in the annuity out to me over my lifespan or over a set period of time. There's a number of different ways I can select to have the insurance company pay the money out to me. Now, before we go on here, I want to mention and make sure you understand, every annuity sold has the ability to go into stage 2. However, a very high percentage, in the 90 percentile of annuities, never go into stage 2. What does that mean? That means that people pay money into the annuity and then take it back out and cancel the annuity. There's no requirement that the annuitant ever go into stage 2. However, it's an option available in all annuities sold. Okay, so we have stage 1, which is the accumulation or pay-in period where we're paying our money in. We have stage 2, which is contractual. We have the option to go into this anytime we want. We have to notify the insurance company. This is when we get the payout over our lifespan or for a set period of time from the insurance company. Now back to our example here. We're in our pay-in, stage 1, accumulation stage. We're putting our money in, and the money slowly starts to build. Now on top of this, the insurance company is going to pay us interest. Now, for this exam, primarily the questions are going to be based on what are called fixed annuities. And fixed annuities for the exam have a fixed interest rate. So you buy a fixed annuity, they'll say, we'll pay you 4% for the life of the annuity. Okay? This is very similar. The money in this account, you could think of it as similar to the cash value in a cash value life insurance policy. You pay your premium in there, it slowly starts to build. On top of the premium, the insurance company is going to be paying you interest. And remember, we said if it's a fixed minimum rate of return, and since this is a fixed annuity that we're going to be talking about here on the board, the money held here is held at the insurance company in their general account, right? Okay, that's general account synonymous with a fixed annuity. And since this license primarily will only allow you to sell fixed annuities, remember you had to go get a securities license to sell variables, most of the questions are going to be on fixed annuities. So we'll kind of focus on that. Okay, so the interest that accrues on my money is fixed, minimum. So who's the investment risk to in a fixed annuity? The insurance company, right? Because remember, they have to pay you a guaranteed minimum rate of return. If the rate of return they can earn is less than that, they have to make up the difference. So the investment risk in a fixed annuity is to the insurance company. Okay, so we're paying our premium in here. On top of that is interest. Now, a big benefit of an annuity is the interest that accrues in here is tax deferred. Tax deferred till when? Till we get it out. So remember I said a little bit earlier that a lot of banks are offering these annuities as a secondary option to a CD. Big difference in the CD, the interest that's earned is taxable to the CD holder every year. Well, not in an annuity. In an annuity, as long as the interest stays within the contract, it's tax deferred. So it's a big tax advantage, and it's because the annuities fall under the life insurance umbrella, they receive that tax advantage by the IRS. Okay, so our money's accumulating here, interest is growing on top of that, tax deferred, minimum guaranteed rate of return, safe, pretty safe investment here. So I said we're paying our premium in. Well, how can we pay our premium in? Well, there's a number of different options that we have, just like life insurance policies. Okay, we can pay a flexible premium, which we'll say in our example that we do here, we pay in whatever we want, at whenever time we want. And remember, with annuities, a lot of times there's minimums that you have to invest, but it could range anywhere from an initial investment of $50 all the way up to $25,000. Okay, so it just depends on the annuity, depending on the company. There's all these different types of products out there, but remember, what we try and focus on is the basics for the exam. Okay, so we can pay in a flexible premium, which we do here. Now remember, our goal is $100,000, but we're going to try and get in there, whatever we can, whenever we can. Maybe we work on commission. Well, that's a flexible premium. Deferred annuity. Now this term back here we mentioned, this is a deferred annuity. Most all annuities are deferred. And what deferred means is we're deferring going into stage 2. Remember, you can only be in one stage at a time. You can't be in stage 1 and 2 at the same time. You're either in stage 1 where you're paying money in there or the money's sitting there and the interest is accumulating, or you're in stage 2 where they're paying the money out to you over your lifespan. Remember, I also said you don't ever have to go into stage 2 if you don't want to. This is an optional thing. So what I'm deferring is going into stage 2. I might never go into stage 2. I might at some point just cancel the annuity and get all the money out, or I might just let it sit in there until I die. Okay? But a deferred annuity is one that's deferring going into stage 2. So if I pay a flexible premium, it's called a flexible premium deferred annuity. Well, I can also pay, though, a fixed or level, meaning the same thing, premium into my annuity. Saying that might be a better example here, because if I want to have $100,000 in the account by the time I'm 65, in 35 years, I might want the agent to tell me, in fact, exactly how much per month I need to pay into the annuity. Okay, so I could do a fixed or level premium deferred annuity. And the last option I have is a single premium. Now, there are two types of single premium annuities. We have a single premium, number one, immediate, and a single premium, number two, deferred annuity. Okay, what's the difference between these two? Are we going into stage 2 immediately? If we are, single premium immediate annuity. Are we deferring going into stage 2 until some point in the future? Single premium deferred annuity. Okay, so there's the big differences there. Now, here's the different ways you could pay in. Well, now we need to talk more specifically about this pay-in period. Okay, say we have money that's accumulating in this pay-in period. And what about this? Say that I want to cancel the annuity. Say I don't want the annuity anymore for whatever reason. Maybe my situation changed here where I don't need that annuity anymore. So I cancel it. And we'll say that I've paid in $5,000 in premiums, and the account balance has grown to $2,000, for a total of $7,000 in the account. Okay, so I paid in $5,000. The account balance has grown by $2,000, giving me a total of $7,000. Now this growth here is the interest. So I pay in $5,000 in premiums. I have $2,000 in growth in the account, so I have a total account balance of $7,000, and I cancel the account. Now, depending upon when I do this, when I cancel the account, the insurance company can levy what they call surrender penalties. And with some certain types of insurance policies, life insurance policies, you will see these as well. Now, a surrender penalty is not a tax penalty. It's specifically a penalty the insurance company charges the annuitant for canceling their contract early. And for example, right when you buy the annuity, it states right in there what the surrender penalties will be. And maybe in the first year, they start out at 8% of the account balance that you'd have to pay as a penalty if you take cash surrender of the annuity. Second year, maybe 7%. Third year, 6%. Fourth year, 5%. And so on until it is reduced to 0 after a period of time. Anywhere from 7 to 8 years. So this means if you want to cancel your annuity without penalty from the insurance company, you're going to have to wait until the surrender penalty is reduced to 0, which might be at the end of the 8th year of the annuity. Now, what are they trying to prevent here? Short-term investments. This is not a short-term investment. The insurance company does not view this as a short-term investment, and that's why they have those surrender penalties. Now keep in mind, the surrender penalty is not a tax penalty levied by the IRS. This is levied by the insurance company. It's a surrender penalty. And they will levy that. So the first year, say, if I cancel my annuity, I have to pay an 8% penalty of my account balance to the insurance company. Okay? So those are surrender penalties. Keep in mind that those might, that's how those work, and those might apply depending on when I'm canceling the policy. Okay, so we'll forget about those. We've explained those, but we'll say in our example here, we're beyond those surrender penalties, so they've gone down to 0. And we cancel a full contract, we get out $7,000. Well, here's my question though. I want to know about tax. I want to know about taxes. Do I have to pay any tax? The answer is yes. Now, I need to figure out, though, how much I'm going to have to pay in tax. Well, here's what we do. We subtract from what we receive what we invested. And the amount we invested is referred to as our cost basis or basis. We subtract that from what we get out. The difference, $2,000, is taxable as at ordinary income tax rates. Now, keep in mind, when you have tax questions on this exam, which you're probably going to have a few, the answer is never capital gains tax rates. It's always going to be ordinary income. Now here's something new though, because you learn about taxes when we talk about life insurance. Somewhat similar to this. Here's something that's different though. On annuities, there is a 10% IRS early withdrawal penalty on any interest that's withdrawn during stage 1 of the contract. That's withdrawn prior to age 59 and a half. So let me restate that. I know it's a lot to say in one statement. I'm telling you, if you withdraw any interest from the annuity under age 59 and a half during stage 1, there will be a 10% penalty. 10% IRS early withdrawal penalty on any interest you withdraw. So in our example, we'll say that we are age 40. We cancel the annuity. Remember, no surrender penalties, we're beyond that point. We get out $7,000. Using the example up here, we paid in $5,000. Interest accrual was $2,000. Total account balance of $7,000. We cancel it, we get $7,000. We have to pay ordinary income tax on $2,000. That was the difference. That was the tax deferred interest. Plus, we have a 10% penalty on the $2,000. So we have ordinary income tax on $2,000 plus a $200 penalty that we're going to have to submit to the IRS as an early withdrawal penalty. All annuities have this 10% penalty. Okay? Now let me change this around a little bit. Let's say instead of canceling the annuity, I take a partial surrender. Okay? I take a partial surrender at age 40. Using the same numbers I have here. I've paid in $5,000. My account balance is now $7,000, the difference being the tax deferred interest. I take a partial surrender, which some annuities will allow you to do, depending on the insurance company. I take a $2,000 partial surrender. Is any of that taxable? Here's my question, the question they might have on the exam. Is any of that taxable? The answer is yes. Taxes related to withdrawals on annuities are taxed differently than withdrawals and taxes related to life insurance policies. Life insurance policies were taxed as first in, first out. This is for life insurance. So they call that FIFO, first in, first out. On life insurance policies, if you're going to withdraw part of the cash value, it is deemed that you're withdrawing the amount you invested first. So you are only taxed if you withdraw more than you invested, and then you would get to the interest. So in life insurance, when you take a partial surrender, you are taxed as the first dollars in, your cost basis, the amount you've already paid tax on, your premium, are the first dollars out. FIFO they call it. Well, that's life insurance. Annuities are different. You take a partial withdrawal on annuity, it's not first in, first out. It's last in, first out. So this applies to annuities. So if you're going to take a partial withdrawal of your annuity, you're withdrawing the interest first, which was the last in the pot. What's the first in the pot? Your premium, right? Because the interest stacks on top of the premium. So if you're going to take a partial withdrawal, your tax is last in, first out. LIFO is what they use for annuities. So, back to my example, I paid in $5,000, it's grown to $7,000, I'm age 40, I would do a partial withdrawal of $2,000. How much of that's tax? 100% of it. All of it. Because it's all interest. Do I have a penalty? Yes, 10% penalty. Okay? That's how taxes work for the annuities in the accumulation stage. Alright, so I know it's a lot of stuff on taxes, but you probably have some tax questions on annuities, and it's very confusing. Now let's go back here and let's say that I'm paying in my premium here to my annuity, the account's balance is growing, interest is accruing, tax deferred, and I die. Okay, hot air balloon accident, we hit a power line, everybody's fried. Well, I have this annuity. Do I have a beneficiary for my annuity? You bet I do. So I list down here my beneficiary. What will my beneficiary receive when I die? Are they going to receive a tax-free death benefit? No. That's life insurance. This is an annuity. I have a beneficiary, but they're going to receive a return of my investment in the annuity. Will they have to pay tax? Yes. Is there a 10% penalty? No. 10% penalty is waived for certain situations such as death, disability. Some of the situations we talk about with the retirement plans and the qualified plans, sometimes the IRS will waive that 10% penalty, death being one of them. But the beneficiary will still have to pay tax on any tax-deferred interest that they receive. Okay, so that's the gist of the pay-in period of the annuity.